Hello and welcome back to Volatility 411. I'm Kevin Davitt, part of CBOE's Options Institute, and it's Monday, January 31st. Last week, U.S. equity markets continued to swing with considerable velocity. So from Monday to Friday, the S&P 500 moved in a 5.3% range relative to the January 21st close. Intraday volatility is back at levels last observed in March of 2020. Nevertheless, on a weekly basis, the VIX index declined by just over a point and closed Friday at 2766. 30-day at-the-money options in the S&P 500 closed on a 22.8% implied volatility. Now, as a reminder, that type of information can be accessed on CBOE's Insights page under the week that was. But here and now, it's the last day of the month. The S&P 500 is lower by about 7% month to date, which is a bigger drawdown than we saw throughout last year. The small cap Russell 2000 is lower by more than 12% on the month, so small caps underperforming. The VIX term structure can best be described as flat. The front two standard futures are trading right around 27. In fact, the whole term structure is trading within 80 cents of 27 even. Historically, that type of VIX futures curve is indicative of uncertainty, but not panic. The Fed meeting is now behind us, and the markets expect a hike at the March meeting. There's a slight possibility of a 50 basis point move based on Fed fund futures at that March meeting. Short-term interest rates have been moving higher fairly quickly, whereas the 10-year and 30-year yields have been relatively stable. So that translates to the interest rate term structure has been flattening. Earnings will continue this week, and they include Amazon, Alphabet, and Facebook. The key economic data point will come on Friday with the non-farm payroll data. That's Volatility 411 from Monday. Thank you very much for tuning in.